Hello guys, it's Castaway Trader, and today we will continue talking about my cycle trader indicator, my most sophisticated and advanced indicator for TradingView. And today's lesson will be about a price trending up. We will talk about how a trend up starts and how a trend up finishes, and how to identify when price starts trending up and it ends trending up using the framework provided by the cycle trader indicator. Please read that important disclaimer. In the previous introductory lesson, we talked about the daily support and resistance, the blue line and the red line that are drawn by the cycle trader indicator. And the main idea is that when price keeps bouncing in between the support and resistance, the market is in a balanced condition, in equilibrium, and it's very difficult to make money when price chaotically bounces in between the support and resistance. It's much easier to trade and make money when price starts to trend up or down. And to start trending up, price needs to get over the daily resistance, and when price breaks under the daily support, it starts to trend down. Let's look at that case. It's crude oil 30-minute chart, and it's November-December 2023. So when you see that price spends a day in between the red daily resistance and blue daily support, you know that the price is in balanced condition. Again, you see it goes up, down, like really difficult to trade, but anyway, price still respects those two levels. You see it tried to break down, failed, it tried to break down, failed again, and I keep telling you that trading is a zero-sum game, meaning that every failure of bears would trigger a rally, and here failed breakdown triggered a bounce. Another attempt to break down failed. You see those long wicks. It's a solid sign that there are buyers here, and normally that's a great reversal pattern. Then bears fail to break under the support, and a new very strong rally starts, and where it goes right to the daily resistance. But it's still not a trending market. When trading market started, it is the same day, 28th of November, when price opened the evening session over the daily resistance for the following day. So the cycle trader indicator will recalculate and post new support and resistance levels at 7 p.m. Eastern time. And if after a balanced day, price opens up over the daily resistance of the following day, that triggers an evening buy signal. And you can see that after evening buy signal, we got a strong buy signal pre-market, and then we got a very strong rally. And look where that rally found resistance, at the purple line. Those purple lines are so-called, I call them the secondary resistance. Those lines are reserved for a trending up market. In majority of cases, a trend up starts after the price builds some base in a sequence of range-bound days. Those are days when price keeps bouncing in between of the blue support and the red resistance. If an uptrending market, price spends 80-90% of the time over the broken daily resistance, then the question is, what is the active resistance for the uptrending market? And the answer is that purple secondary resistance lines. You see, they're in uptrending market, then the background is green, price tends to find support at the broken red resistance. So the red resistance becomes your key support. And as long as it holds, we can close our longs at the purple line. Sometimes that purple line will get broken. For example, look, buy pullback signal, and then another strong rally, and that rally goes to the purple line on the day, this is 30th of November, and look how many attempts it took bulls to get over that line, and they failed. So you can see those candles with long wicks. So it's a great reversal pattern, and when you see several of them, at least two such candles, that means a failure. And again, I keep repeating to you, trading is a zero-sum game. If bulls fail at the resistance, what happens? It inspires bears to counterattack, and first you see a very strong drop to the next lower level, and the next lower level was the red resistance, but in that particular case it couldn't hold the decline and it was a breakdown. Breakdown happened, price dropped to the following level, that was the blue line, and started to consolidate. And look what happened. That same day in the evening at 7 p.m. Eastern time, price opened the evening session under the daily support of the following day, because the cycle trader indicator would start plotting a support of the following day at 7 p.m. of the current day. And it opened under the daily support, and that was a short signal. Price kept consolidating until the noontime next day and then dropped again. Failed attempts to break over the secondary resistance, the purple line, can be considered a risky short setup. You see, price went up here to the purple line, it stopped, turned down, a short setup, another test, and the second test normally has better chances to break out, but it couldn't. Here you could short, but soon enough you would get a long setup, and it started another trip higher, another multiple test of that purple line. Bulls failed to break out, and that was a short setup. It's very important to understand that when bulls manage to break over the upper purple line, that confirms price is in an accelerated phase of a rally. Think of a wave 3 up under the Elliott Wave theory. That means bulls are very strong, all pullbacks are shallow, and it's extremely dangerous to try to fight that move and short it. When price kicks in a turbo accelerated mode over the purple line, it becomes too dangerous to fight the move up. And we have a trick. The trick is you have to wait when the distribution phase starts. That means that a breakout over the secondary resistance, the purple line, will inevitably be followed by distribution phase. Distribution phase can be recognized by 1-2 days when price spends bouncing in between of the daily support and resistance. Let me show you an example. So this is where price goes up and it hits the secondary resistance, the purple line, and you could try to short it, but soon enough your short will be taken out when price goes over the purple line again. This is why I say that the test of the purple line can be used as a short setup, but it's a risky short and you should be prepared to cover your short as soon as it drops after 2, 3, 4 candles. There is no any guarantee that a test of the purple line would turn into a sustainable trending move down. When price hits the purple line, it actually confirms the strength of the bullish trend. You've got to wait until a distribution phase starts. Look, the following day, again, price spans over the red resistance line. And the law of the trading of the market says that in an uptrending market, price spends the majority of time over the resistance. And here you see a perfect example. This is an uptrending day here. This is an uptrending day here. So that day was kind of tricky because price dropped under the daily resistance, and that could become a distribution day, because the two trending up days was followed by a day when price spent the day inside the range, under the resistance, over the support. But look what happened then. We got a strong buy signal, and by the end of the day price started to move up again, and it climbed over the daily resistance, confirming that it's still in an uptrending mode. And look what happened then. By the end of the day, not only it hit the secondary resistance, it broke over that resistance. It's ES mini 60-minute chart. It's June 2023, so it was a breakout. So this is why, again, shorting test of the purple line, it's risky. At least you need to get a candle, 30-minute or 60-minute candle with a long wick that goes over the line but closes under. That's a solid short setup. It's risky, but at least you have chances to make money. Or in that case, you see we got a spiky candle that was faded down, so leaving that long wick. That's a bearish sign. That's a sign of rejection. And if you go short, you really need to put a stop right over that purple line. But when distribution starts? Distribution starts when after a series of uptrending day with acceleration. So this is an acceleration up because price goes over the secondary resistance. There comes a day first when bulls fail to get over that secondary resistance. Like, look, the same happened here actually. As soon as bulls failed to get over the secondary resistance, it's a failure. And what I keep telling you, a failure of bulls almost always triggers a move down. And look what a strong move down we got, and where that move down stopped? At the next level down. And in an uptrending market, the red line, the daily resistance line, is the key support. And in that particular case, bulls defended the key support. But that failure actually carried over for the following day, and that day started as a distribution day because it was traded inside the range. Here happens the very same pattern. Bulls tried to get over the secondary resistance to confirm an accelerated phase, but we couldn't. We got rejection and we got a drop, and that drop was moving down almost up to the next level that was the daily resistance, the key support of the uptrending market. But the following day, look what happened. Price spent the whole day inside the range. So that means the trend was questioned at that point because bulls could not break over the daily resistance. And we got the evening short setup at 7 p.m. Eastern time when we recalculated the daily resistance and support for the following day. And look what happened. It happened that price opened the evening session under the daily support, and that is the condition for a downtrending market. And you see the background changed from green to red, and that same day price dropped. And what was the target? The secondary support, and we will be talking about the secondary support in my next video. And this is another example. You clearly see now how to recognize an uptrending day when it's too dangerous to short it. And that day is when it spends the whole day over the red daily resistance. That's a clearly uptrending day with price breaking over the secondary resistance, and meaning that it's in an accelerated mode. The next day, the whole day was spent over the secondary resistance. And the next day, we see some slowing down because price spends the day over the daily resistance, but way under the secondary resistance. So that was the sign of deacceleration, but it was still trending up. We get that strong buy signal and the final exhaustive push higher to a higher high and sell long signal. And in one of the following lessons, we will be talking about that sequence. And in many cases, that sequence strong buy, sell long becomes the final nails in the coffin of the bullish trend. But anyway, we see that on that day, price was going to get over the daily resistance but failed and closed the day inside the range. That was a solid warning signal for bulls. Look, after several days when price was trending up strongly, and spent a lot of time over, even not only over the resistance but over the secondary resistance, so the sign of super strength. Then comes the day when price actually ended down inside the range, so that was the first day of distribution. Then comes another day when price makes a really narrow range, and again it spends the day inside the daily range, another day of distribution. And then comes another day, and again bears repeatedly try to break under the blue support. Look, it did not happen here. Blue support was way below, and then comes the day that bulls actually got exhausted. They could not only they could not break over the daily resistance, they hardly could defend the daily support. So this is when you start thinking about the short, and you wait for signals. And you see here you got the first short setup. Why? Because here price made a lower low, and here price made a lower high. So before you start considering going short, you wait for price start making lower lows and lower highs, and the cycle trader indicator does it work for you. So I coded it in the way that it keeps comparing highs and lows, trying to find patterns that would help it to recognize change in trend. And finally, you see after 3 distribution days, when price spent 3 days inside the range, where was an evening session, 7 p.m., price opened way under the blue daily support. That was a striking difference to what we had during the previous 7 days, and a new trend down started. So here you see the green background, here you see the red background, and you see how the character of the market changed. But here we saw acceleration, and half of that cycle up was actually spent on distribution. And this is what normally happens. This is what how normally price builds tops. They kind of rounded tops. It takes time to build it up. So what we will be talking about in the next lesson? We will be talking about secondary support. When bulls manage to break under the lower green line, that confirms price as an accelerated phase of a trending move down. Think of a wave 3 down under the Elliott Wave theory. When price kicks into a turbo accelerated mode down, it becomes too dangerous to fight the move down. It becomes too dangerous to go long. They say you shouldn't catch a falling knife. And in the same way, I'll show you several cases that shows you that when price goes down in accelerated mode, it makes sense to wait until accumulation phase starts. Thank you and good luck with your trading.